Hello and a very warm welcome to Econoday Unplugged on Tuesday, the 10th of October 2023. Mark Pender's on the US East Coast, Max Sarto's in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. Well, it took a while, but investors now seem to accept that many central banks will be keeping key interest rates at high levels for longer than originally expected. And with that comes increased downside risk to financial markets and economic growth. Just last week, the yield on US 10-year treasuries, widely regarded as the most important single interest rate, climbed above 4.8% for the first time in some 16 years. That was up, 70 basis points since just the start of September. In Europe, its German counterpart hit levels not seen for 12 years. And in Japan, 10-year JGBs are only still sub 1% due to intervention by the Bank of Japan. And while yields have slipped this week, they would almost certainly be significantly higher, but for the Hamas attack on Israel at the weekend, which prompted an immediate shift into risk-off assets. Not helping matters, many curves are still inverted, encouraging investors to shorten duration in a bid to get higher returns. As it is, recent developments have left bond investors sitting on massive losses and borrowers, be they consumers, companies or governments, all totting up how much it's extra it's going to cost them to service their debt. At the same time, the dollar has strengthened further, which threatens to boost prices overseas, just when it seemed that inflation in many countries was finally being brought under control. So against this backdrop earlier today, the IMF trimmed its global growth forecast for 2024, although of note, that masked upgrades to both Canada and in particular the US. So with all this going on, time to find out how the Econoday team think things are going to pan out. So let's go to the US first then. Mark, there's been a lot of speculation about Fed tightening again before the year is out due to the surprising buoyancy of the local economy. So first question then is, do you think this steep climb in yields is a genuine recession risk, or is it simply a necessary development to help to ensure that inflation falls back to target?
Well, I guess it's both. It's definitely an inflationary risk, and it's part of the effort to contain inflation. The Hamas situation has, I guess, clouded what the data would seem to point to a rate hike that the Fed has already penciled in, one more for the rest of the year. And on Friday, we had a very robust employment report, very surprising employment report, over 336,000 non-farm payroll gain. And it was just out of, way beyond Econoday's consensus range, the outside of consensus range, and really underscored an upsurge in strong economic data, as you could see from the Econoday's relative performance index, which after that was at 38, which is a pretty significant indication that just like through most of the course of this year, and why the Fed has been having to kind of chase interest rates in a way, data has been outperforming expectations, whether it's the FOMC forecasts or whether it's private economists. So now, what's interesting about that, if I could very quickly, was they had a 4.2%. We had a 4.2% average hourly earnings, which is the wage indication here in the U.S., and that was down a tenth. Interestingly, the monthly rate, which is very highly forecast, came in at 0.2 for a second month, which is really tame. If you multiply that by 12, that's pretty much where your target. It actually under 3% for wages is what the Fed would like. So on a year, so it looks like that's pretty good, but it's stuck at this higher level, this plus 4.2 level for right now. Now, whether or not we can get a long series of 0.2% monthly increases that would bring that down to target, I guess is in question. I guess and we're having the CPI out on Thursday here, and the Econoday consensus for that is very similar. It's a 0 point to those results that we saw with the wages. That is a modest monthly gain, which would be part of what hopefully is an emerging trend, I guess. Of course, hopefully, when it comes to the CPI, and but still an elevated annual rate. So if we want to look at the core rate, or the headline rate, we're expecting a 0.3% rise, which shouldn't further increase interest rates. It wouldn't put a lock on a rate hike at the end of the month.
Okay. Well, as you mentioned, I mean, our relative performance index has been showing outperformance versus market expectations by the US economy for some time now, pretty well across the board. But so we have had this, significant backup in yield. So, I mean, given that there still appears to be different sort of mutterings coming out of the various FOMC members, and for people who haven't seen it, I guess I should mention that we have seen the Fed Vice Chair Jefferson and Dallas Fed President Logan suggesting that the run-up in yields might actually help to reduce the need for further interest rate hikes. I was going to follow that on with the question, do you think what we've seen so far at the margin might help to prevent the Fed having to tighten interest rates again? Or do you think, given the kind of robust situation of the economy you're talking about, they're still more likely not to hike before the end of the year?
Well, they left their last meeting in September with definitely a hawkish bias. And at that time, the economy was really performing very solidly, especially the employment sector, which is absolutely key. So that's all. I guess part of their the central bank concerns are having this patience to wait if prior rate hikes, which have created this increase in interest rates in the first place, if these effects are playing out, have they played out? There seems to be a patience that we can wait for this. I mean, just last week we saw, and I guess we can talk to Brian about this, but the Reserve Bank of India, I think it was the fourth meeting in a row, their inflation rate is, I think, in the 6% range. So central banks here have been showing a lot of patience, waiting for this effect to occur. And so I guess what my point is, Jeremy, that it may be occurring, but it's maybe bringing down inflation in a slow motion kind of a way, and there may be the risk that inflation has just the natural rate of inflation, if there is such a thing, has now ratcheted higher beyond their 2% target. So, in theory, if this went on, the central bank would have to change their targets. Maybe the new normal. Remember, we had all this years of disinflation and deflation for 15 years. No one could figure it out why, and we were at close to zero, on interest rates, and that was fine, having a 2% goal now. But so maybe things have changed now, and it's over.
Well, on that front, it's a fair point, but I guess the idea of changing a central bank's inflation target is pretty sizable, and it'd be a big risk to how financial markets would react. But I suppose kind of linked to that, what I was going to ask you, I mean, given the fact that this US economy has been, at least in broad terms, outperforming for so long now, do you think it effectively means that the real equilibrium interest rate now is somewhat higher than it used to be? So the idea perhaps of people expecting interest rates to go back down to, let's say, close to where they used to be is simply off the wall now. Interest rates will have to stay, perhaps not as high as they are now by any means, but cuts in interest rates when we finally get through to the bottom, it's going to leave a higher rate than people originally thought we'd finally end up going back down to.
That's a possibility, and that goes with what I was saying about a parallel line with inflation. But it's not all bad. You were talking about losses for bond investors, but the bill investors, in short-term treasuries are savers right now are doing fantastically well. It was, for so long, savers were being punished at zero interest rates, and now they have a chance to we're talking about the 10-year yield coming in at a long-term high. These are not only like near 20 years high. You have to go way back. I mean, we're at really high levels right now in some of these longer term, or we're approaching, substantially rich yields in U.S. Treasuries, and so and that's a plus for some in the economy, who haven't bought, who aren't locked in unfavorable prior investments. But so it's an interesting mix, and I think you're right. I think that there could be a new normal, and if there is a new normal, then the central banks will all have to, get together, recalibrate. It's interesting, when you look at the central banks that we cover. I think there's only really one. I can't remember which one it is. It may, besides the Bank of India, which has a much higher target range. There's like one other bank or the Swiss bank. They don't even have a range, right? They just want 2%.
Well, they just want slightly below 2% is their definition of high stability.
Okay, slightly below. So, all right. So, but most of it's 2 to 3%. The Fed has a flexible 2% range. But all this is, and they base their forecast. When will it approach there? And all their forecasts always have, by the end of the forecast horizon, it's virtually at that spot. And of course, that's the long term or the medium term, whatever it is, and it hardly ever happens. But we'll see how it happens. But like I was saying, the central banks are clumped in around this 2 to 3%. What they're basing their policy on, and I think as far as they believe that they probably have already done enough to bring that down within there if they just wait long enough. But whether or not that works, we'll see.
We'll see. Okay, thanks very much for that, Mr. Pender. Let's move north of the border to Canada. Max, well, I guess a bit like the US, really. The Canadian economy is doing at least pretty well, and certainly better than expected for most of this year. I think if I got my numbers right, Econoday's relative performance index is up at 47. So really, the same kind of question to you really. Canadian dollar, their 10-year yields hit, 16-year highs last week. So is that a threat to growth, or is it something which the Bank of Canada, given the way the economy is performing at the moment, it'll be quietly welcome?
Interestingly, last month, after leaving the rates steady, one of the deputy governors said in a speech that they've been following the inflation rate and other measures, for example, CPI minus mortgage costs. And she said it is actually slightly lower, but not that much. So that means they're not extremely concerned about the mortgage costs pushing up the inflation rate. And as for the rising borrowing costs impact on consumers and businesses, of course, some do have variables, but not all. So that means Bank of Canada was looking for normally bad news for the economy, which is slower spending, slower investment. And now they think decision making is getting a little bit more difficult. They have to look at both upside and downside. So that suggests that they may not have to tighten so much anymore.
Okay, let me ask about the employment market. I think actually on the last podcast we chatted at least briefly about that and said, since the BOC came out and started to note that perhaps the labour market slack was beginning to open up a little bit, the unemployment rate had moved up. But since then, well, at least over the last 3 months or so, we've seen the payroll numbers exceeding market expectations. We've had almost 100,000 jobs added over the third quarter. The unemployment rate is still down at just 5.5%. So I mean, we put sort of the bigger picture together. Even given the hike we've had in longer dated yields, do you think there's enough momentum in the Canadian economy that they're going to find it difficult not to push interest rates up again at some point, or do you think we've actually topped out now?
That's a good question. The latest data, of course, the employment figure was above expectations, but the gains were led by part-time jobs. Meanwhile, average hourly wages ticked up to 5% 1 year. So that means maybe keeping the Bank of Canada people a little bit nervous about the labor costs. So I don't think they want to declare that they're done and just want to see the cumulative effects of tightening. I think they still want Canadian consumers and businesses to slow down a bit before they can see the inflation is roughly within the range of 1 to 3%. And of course, they have said before that they want to go all the way down to 2%.
Right. So in other words, reading between the lines, you're effectively perhaps saying that the rise in yields we've seen so far don't actually be too unhappy about.
Exactly, yeah.
Right. Okay. Right. Well, let's move on then. Keep this ball rolling. Move into Asia. I guess as we mentioned on previous podcasts, a strong dollar and high US interest rates is not a particularly great combination as far as the Asian currency world is concerned. So moving into Japan, back again looking at the exchange rate, dollar yen threatening, particularly last week, to break back above the 150 mark again, which we know doesn't sit at all well the likes of the Bank of Japan or the Ministry of Finance out there. The central bank has been forced to bolster its JGB purchases to try and keep a lid on yield. So what's the outlook, do you think, now for BOJ policy?
The BOJ, of course, they are watching the dollar yen rate together with the MOF. And it's not clear the MOF decided to intervene or not recently. I think the latest policy stance is not to tell anybody what they're doing or what they're going to do. So
they can't even plan, no less.
that will probably, previously, if they intervened, they did announce in a big way. I think, when the impact was big, especially when they get help from the Fed, Treasury. But now they know that the dollar buying pressure is still too high. They don't want to disclose their hands. So I think they're going to stay quiet that way. And for the Bank of Japan, I'll give you a few numbers. If you take a look at the latest CPI, that's national average for August. Goods prices seems to have peaked out. Total goods minus fresh food. The index was up 4.1%, but that's compared to January. Down from 7.2, and meanwhile, so that's good news for the Bank of Japan and consumers and businesses. Service costs, service minus owner's equivalent rent, that's up 3.0% from a year earlier in August, and that's really, for Japan, it's really up from 1.7 in January, which means that's good news for the people. Wages. Companies, of course, passing on higher utilities and all those costs too. But they know that unless they raise the wages, they're not going to get enough people. Not just restaurants, hotels, and construction and transportation. Almost across the board. So that's going to support the economy, but if you also take a look at the forecasts, the latest is from July. That's Bank of Japan's quarterly outlook report, and we're looking for, waiting for another one, most recent in October. But even though CPI is going to probably rise 2.5, that's their forecast. This fiscal year, it's going to go down to 1.9 in fiscal 24 and down to 1.6 in 25. And that's not too far from the private economist forecasts. What that means, they really need evidence that companies going to keep raising wages at a reasonable rate or a substantial rate in the next fiscal year and onwards. So until then, the Bank of Japan's board will be very careful about adjusting the policy. For example, the discussion on whether to end the negative rate policy on the short end. That's going to happen. Obviously not this year, and maybe they'll be careful into the early parts of next year.
Okay, I do ask you about. Look, I saw a report. I think it came out Kyoto, Kyoto Newswire on the back end of yesterday, or earlier on this morning, my time anyway. And there were some rumours there, at least, that the BOJ is considering raising its inflation outlook, say for the current fiscal year to March, from the 2.5% you were talking about up to 3%. I mean, do you think that if that were to be correct, do you think that would be significant, or is it just still going to be the case that, well, okay, inflation is going to come down to basically target or even sub-target, but just from a slightly higher level?
I don't think, I think they're talking about fiscal 2023. And of course, that's going to go up because BOJ did acknowledge in the July report that companies are still raising prices because they couldn't raise all the costs last year in the early parts of this year. So that's going to happen. But then, compared to the earlier levels, CGPI and producer prices have been slowing month to month compared to the last year's levels. So that means that's going to have an impact on the CPI 6 months to a year ahead. So I don't think BOJ wants to highlight too much about a possible upward revision to this fiscal year's forecast. What's really important is, as I said earlier, 24 and 25.
Okay, fair enough. But and a quick one before we move on. 1%, the what is perceived to be anyway the kind of a threshold of pain for the BOJ for the 10-year JGB. And do you think if we continue to see, I know we've had this pullback because of the Middle East developments in yields generally, but if we see that being short-lived and yields generally start to move up again, which will inevitably put pressure on JGBs, do you think the BOJ sees this 1% level as being sacrosanct, or would they prepared to be perhaps come out and say, okay, well now the hint that 1.25% may be the upper limit?
I think they came up with this number last time, thinking that this is going to be not just short term, but more for the longer term operations. So I don't think they're ready to expand it too easily, because that's going to leave the impression that they're basically raising rates.
Right.
And that's going to create a huge yield curve steepening between short and long term. And so I think they're going to have to defend with lots of operations towards 1%, but internally, I don't think they're so concerned about it right now. But then they quoted four sources of uncertainty in the July report. Number one is, of course, prices and the rate hikes by other central banks, and number two is credit risks, and especially they mentioned the cautious lending attitude by U.S. banks. And number three is this is an upside. Korean, Taiwanese information technology exports have hit the bottom and coming up, so they see brighter IT market months ahead. But then they're still concerned about China's real estate market. So those are factors for overseas economic growth risks for Japan. Even though export share has declined in the GDP, if they have to cut exports, then that's going to affect the production shipments and hiring and all that. So see what they're going to say about the new Israeli war. It could obviously affect the oil prices and also shipment routes if the conflict spreads through the Middle East, and also if the U.S. finds they think Iran is supporting Hamas, then that's going to reduce the oil available out of Middle East. But in terms of immediate impact, Japan's the source of top imports of crude oil, Saudi Arabia, UAE, Kuwait, Qatar. So if those countries still keep pumping, then that's almost 90% of Japan's import needs. So that should be okay for Japan for now.
Okay, great. Thank you very much for that, Max. And certainly, as you mentioned there, and what's going on in the Middle East, clearly needs keeping an eye on at the moment. Right, let's move across to China and Brian then. Well, I guess, we worries about the pace of, or I suppose I should say rather lack of pace of recovery has been a feature of the Chinese economy for some time now. From what I've seen, Golden Week seems to have been a bit disappointing. And I noticed a report from Bloomberg today suggesting that policymakers are considering issuing at least £1 trillion worth of additional sovereign debt for spending on infrastructure. So is this 5% GDP target for 2023? Do you think it's still feasible? And when you kind of knit it all together, what's going to happen to the central bank policy going forward?
Yeah, I mean, we just, I think, had the IMF World Economic Outlook come out, and they downgraded the 2023 growth forecast for China, I think, from 5.2% to 5% for this year. So not a big reduction, but just I think further evidence that we're not seeing much momentum in the numbers that we've been reporting for some time now. You have all the the PMI numbers just sort of bouncing around that 50 level for quite some time. So what's going on? I think the main sort of factor that is weighing on any sort of recovery in China is just the continued weakness in the property market. That's also been highlighted by the IMF, and it's clearly something that we've been seeing for quite some time now. You've still got the property developers and the local government debt vehicles in all sorts of bother. Property investment still falling pretty sharply on year-on-year terms. Property prices have stabilized a bit in the last 3 or 4 months, but definitely no signs of a strong recovery there as well. So I think that's probably the main factor that is going to be focused on by policymakers, at least in the near term, and so that might prompt them to do some more tweaks. We've definitely seen a few measures in the last sort of 6 to 8 weeks, and we might be seeing some more of that just in response to this ongoing weakness in the property market.
Oh, yeah, I was going to ask you about the property market. It's clear that the housing market slump has been one of the major problems for the Chinese economy. As you mentioned, it's clearly ongoing. As I recall, they introduced a number of measures trying to boost activity, beginning of September, wasn't it, if I remember rightly? Has there been any indication that that's actually starting to work yet, or do you think it's just, a drip in the pan and they've got to do a lot more?
Well, as I said, we have at least seen property prices, the monthly number that we track, stabilize over the last last few months. It had been falling in year-over-year terms quite sharply, but now it's sort of bouncing around zero. So to that extent, we might have seen some impact from some of those measures that they've put in place. But yeah, as I said, it's still pretty weak, and that might be prompting them to do a little bit more.
And I guess I've also got to ask, the same as looking at some of the other currencies from your region. I mean, there's clearly we've been in a strong dollar environment for a long time. The latest upshift we've had in bond yields in general has certainly lent additional strength to the US currency. So, what's going on with the yuan now? Is it still under pressure? Are we still having to see the authorities doing their best to try and support it? I mean, are they that concerned about recent developments?
Are they concerned? They don't talk much about it, so it's really hard to
fair answer.
What they're thinking. But presumably it's an ongoing thing that they're tracking. They're obviously trying to hoping that exports does provide a bit of an offset to the weakness in other parts of the economy. So to the extent that the yuan does give them a little bit more of a boost to their exports, that will help. They're also fortunate in that inflation pressures are still quite subdued, and so they don't really have to worry about the inflationary impact of currency weakness going forward. So I don't think that's their number one issue at the moment. As I said, property market is still probably the main game in town.
So where are we? Last RBA meeting, if I remember rightly, no change in interest rates again, and still hinting though that if anything, there's upside risk to interest rates, or again, do we think, given what's happening to the world economy at the moment, in the light of these higher bond yields, that chances of additional RBA tightening are now less than they were before?
I would say that's a fair assessment. The risks still are that they might need to go at least one more time, and there's definitely a few people predicting that. But what we are seeing in bond yields and the outlook for growth might mean that they don't have to do that or don't want to do that. So we'll see. And there's certainly in their monthly statements and other public comments highlighting the downside risks to growth, as well as still indicating that inflation is a concern. What we are seeing, and this is true of other countries in the region, is that officials are looking past any sort of volatility in headline inflation. So the monthly CPI number for Australia showed a bit of an uptick after it had been trending lower since the start of the year. But that was mainly due to fuel prices and base effects and things like that. So that didn't spook the RBA when it saw that number. And when you look at the core number, that's still heading in the right direction. So they're still confident that the policy tightening that they've put in place will work and get inflation back towards its target over the forecast range. So I think at the moment the thinking is that they've done what they need to do, and they just have to sort of hold the line going forward.
Okay, and well, just following on from that, I guess you've kind of answered it in terms of what you've just said, but there has been some speculation, I think, that the RBA might, change its view on holding bonds to maturity and actually go out and start selling bonds. So, in other words, active quantitative tightening. Is that still a possibility, or again, do you think what's been going on in the bond markets has made that again simply that much less likely?
I think it is less likely now, and as I said, they're still hopeful that what they've done already will be enough to achieve the policy goals that they've got set for themselves. I don't think there's a lot of interest in trying to go back to using different types of policy tools to reach their objectives. I think they would like, if possible, just to go back to the tried and true methods. And of course, they're also not only looking at what bond yields are doing, but looking at the weaker Australian dollar as well. And so that's feeding into them as well. That's obviously presenting a bit of an inflation risk, whilst also hopefully providing a bit of offsetting support to the economy through exports.
Okay, moving on then, if we can, let's move across to New Zealand. Any particular update you'd like to mention there? Again, particularly with regard to what's going on in the bond market, has that had any effect on Kiwi financial markets, or indeed the attitude toward growth prospects?
It's a very similar story to Australia.
Right.
And again, I think with the latest New Zealand RBNZ decision, just what was it, last week, I think. They again are fairly confident, I think, that they've got policy settings right, and that they just have to sort of now hold the line and wait for it to do what they think it will do, and in terms of slowing the economy and getting inflation back down. We have to wait for the next quarterly inflation number, and so we haven't yet seen what we've seen in Australia, a bit of a pickup in headline inflation in response to some sort of recent developments. So that'll be interesting to see if we do get a bit of an uptick in the headline inflation in New Zealand when we get that quarterly number. But I think they're pretty confident that the underlying price pressures are moving in the right direction there. Okay,
fair enough. And rest of the region, if you'd like to make any sort of general comments about what's going on there, the trends?
Well, I think, again, this is a common theme across the region, where we are seeing a bit of a volatility in the headline inflation number, but policymakers are looking through that, and that was again evident with India. We mentioned that earlier on in the talk. Reserve Bank of India again left rates on hold at its last meeting, even though we have seen a bit of a spike higher in headline inflation there, but that's just basically reflecting volatility in food prices, which often happens around this time of the year if rainfall patterns don't cooperate. So not worried about that. And instead just looking at the core inflation numbers, which are more are behaving better. And so again, I think it's sort of pretty confident that they've got policy settings where they want it to be for the time being. So, and again, you can say the same thing about Korea, South Korea, and then we've got Singapore, their semi-annual policy review coming out in the next few days as well. So it'll be interesting to see what happens there. But I think, again, they'll be reasonably steady with what they want to do with policy.
Okay, great. Thanks for that, Bron. Right, let's wrap this up then with a bit on Europe. What have we got here? Well, I guess as far as Europe's concerned, it's part of the weaker areas of the world at the moment. Looking at the Eurozone first, it's still the case that most of the real economy data anyway remains soft, albeit largely in line with market forecasts. Econoday's relative performance index has been hovering fairly close to zero for a little while now. And indeed, where we have seen surprises in the data, it's mainly been on the downside, and that's been due to weakness in the inflation report. So that's good news as far as the ECB is concerned. Third quarter growth looks likely, I guess, to be around zero at the moment. I mean, the likes of retail sales, they're at their lowest level since last December time. Industrial production's been falling for quite a while. So I guess it's fair to say that higher bond yields in Europe perhaps are more of a risk in terms of a threat to recession than they are in a lot of other parts of the world. In particular, if you look at some of the more interest rate sensitive sectors such as construction, was a very weak PMI for the construction sector out of the Eurozone. That was down at just 43.6 in the latest figures for September. So to all intents and purposes, quite deep into recession territory. And we look at, well, I guess in many ways, the worst performing Eurozone member at the moment, but its most important member in terms of GDP, Germany, that was down at just 39.3. So we're talking significantly weak numbers. And indeed, if we look at the house building sectors in general, they're putting out some particularly soft figures now, notably in the big two, France and Germany itself. So the broader picture, very much one in which the real economy was struggling before we saw these back up in bond yields. So the increase in borrowing costs will certainly weigh on economic output going forward. And indeed, it's got to be at least a possibility that we could see the Eurozone being in recession by the back end of this year, if not the first quarter of 2024. Apart from just the pure economics, rising bond yields, of course, have implications as far as financial markets are concerned in the Eurozone. Typically speaking, when we do get a rising trend in yields, it tends to be particularly apparent really in more highly indebted countries, notably the likes of Greece, Spain and Italy. And indeed, in Italy, we've seen over the course of the last few days, the key 10-year, the BTP Bund spread, so the gap between Italian bonds and German bonds, that's climbed above 200 basis points. Now, that's a mark typically seen by investors as a kind of a warning flag for financial stability for the region as a whole, and indeed a potential threat for the euro. Now, the ECB actually came out on Monday, presumably pretty deliberately, to indicate that there's been no discussion as yet on activating what they call the Transmission Protection Instrument, the TIP, which was introduced back in July of 2022 and aimed at ensuring that monetary policy is transmitted smoothly across all the euro area countries, and in particular with a view to countering unwanted disorderly markets. So as mentioned, they've just offering a reminder to the markets that, look, we haven't had to use this, so don't get too agitated about things. But nonetheless, if we do start to see US yields going back up again, which is going to drag Europeans higher as well, there could be some fresh pressure coming through on the euro via the financial markets, and that in turn is going to put additional downside pressure on the euro, which of course is going to help to keep inflation that much higher. And indeed, as Max was saying, with some of the problems in the in Middle East at the moment, that could also help to underpin oil prices or push oil prices higher, which in turn will feed into the inflation numbers as well. So there is a lot going on there at the moment. But certainly I would say in terms of the countries we've been talking about, the Eurozone and indeed the UK, perhaps more susceptible to what's happening in the bond markets at the moment than some of the others. So I'll quickly move across to the UK, and indeed, as people are probably aware, that the housing market in the UK is one of the key factors determining the overall shape of the economy and how it performs. And there we had a September PMI for the sector down at 45, just 45.0 in fact, and that was its first sub 50 reading since June, and the weakest we've seen since going back to May 2020, so during some of the very early days of COVID. It suggests really that the housing market is going to be a big drag on the UK economy going forward, and it kind of suggests that, well, if we believe some of the numbers taken at face value, we could see weakness matching the sort of figures we saw going all the way back to 2009, in fact 2009 outside the pandemic period itself. We'll get an update on how the UK economy is performing on Thursday, where we'll get a key selection of economic data coming out on GDP and the like. That will need to be watched closely because it'll certainly have big implications as far as the Bank of England's concerned. But it's fair to say at the moment, as things currently stand, given what's happening to UK gilt yields, they are up substantially like we've seen elsewhere in the rest of the world. The perhaps slightly disproportionately large implications for downside pressure on UK economic activity makes it that much less likely that we will see UK interest rates going up again, and hence that UK bank rate has probably topped out at around about the 5.25% level. What else? Well, I guess from my side, you quickly mentioned the SNB, the Swiss National Bank. So they left interest rates, as we know, on hold at 1.75% in September when markets were thinking about another increase. Now, the increase in bond yields in Switzerland compared to, well, pretty well the rest of all of Europe, and indeed outside of Europe as well, been relatively limited. And indeed, as back in the last week, they're only at about 6-month highs or so. So not the multi-year, if almost decade highs we've seen coming out of a number of other countries. Still, the economy is sluggish. The Econoday's relative performance index has been below zero for the best part of a year or so now, pretty well on an unbroken basis. Inflation's been below 2% for the best part of 4 months or so. But nonetheless, I think it's fair to say that higher bond yields increase the chances there as well that we won't see any additional hikes coming out of the SNB. So it could well be now that Swiss official interest rates have topped out too. Okay, then that's probably enough for the general roundup. Anybody else have anything else they'd like to chip into the pot before we wrap it up?
Yes, it's Mark from the U.S. that Econoday covers the U.S. Treasury auctions very closely, and we have a 10-year reopening tomorrow. What a reopening means, it's a reissue with a couple of months less maturity, but so the coupon's going to be stuck at 3.875%. But it'll be interesting to see with the U.S. 10-year right now at 4.66. I see right now. So when November comes along and the bonds, the 10-year, the 20-year, well, the notes and the bonds, the 10-year note, the 20-year bond, and the 30-year bond in the U.S., these are all going to be reopenings in the next couple of weeks. When you see those auctions, it'll be the next auctions where those coupons will be going up if yields are still that high. That and we're just talking at the beginning of people or positions that have old bonds, of course, with low yields, low coupons, they're suffering. But new buyers of bonds, so that's the other. There's always a balance of things, and to follow that, I can recommend Econoday's coverage. Those auctions of those notes and bonds are at 1 p.m. Eastern time on your Econoday calendar.
Indeed. Thanks for that, Mark. Bond markets at the moment, very much one of the focal points of international markets in general. Okay, then, so let's finish it there as far as today's concerned. I guess we can say what? Well, in general, the tightening of monetary conditions caused by the rise in bond yields should take at least some of the pressure of those central banks contemplating more interest rate hikes, while for others it could bring forward possibly the timing of the first interest rate cuts, although it's got to be said, don't hold your breath at this stage. All that said, though, much will depend upon yields remaining at high levels, and as last weekend's developments made clear, geopolitics can have a significant impact on that. So events in Israel and the Gaza Strip will need watching closely too. Still, ultimately, it's the data that matter. And so, as we always say at the end of our podcast, do make sure that you're always keeping yourself up to date, and up with an eye on Econoday's global economic calendar. And with that, on behalf of Mark, Max, Brian, and me, thanks as ever for listening. We hope you can join us again next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.